BMNR reported only $11,041 of revenue in the February quarter. Then it talked about $11.6 billion of crypto, cash, and other investments it called moonshot holdings. And now there is preferred stock sitting ahead of common shareholders. So the real question is not just, does BMNR own ETH? The question is, who gets paid first?
By the end, I will show you the exact 5-question checklist I would use before touching BMNR Common, BMNP Preferred, or ETH directly. On this channel, we do not just repeat stock headlines, we build proof gates. What must be true, what can break, and what to watch next. Before we go further, here's how we separate the evidence. Filed facts come from SEC filings. Company claims come from releases or furnished exhibits. Our math is calculated from those inputs. And if a number is missing, we treat it as a risk question. Here's the scorecard. 1, does ETH per common share rise? 2, does staking cash cover the preferred dividend? 3, does cash stay strong after the deal? 4, does custody proof improve? 5, does BMNP trade like investors trust the risk? Keep those 5 gates in mind. They decide whether the preferred deal is fuel or a warning sign. Old BMNR was judged like a Bitcoin mining stock, machines, power, uptime, and mining margins. New BMNR has to be judged like a treasury vehicle, assets, custody, staking yield, liquidity, dilution, and capital access. That changes everything. The company can own ETH, but common shareholders still need to know what part of the economics actually reaches them. Beginner question, do BMNR shareholders actually own the ETH? Not directly. They own common stock in a company that owns assets, has expenses, makes financing choices, and now has preferred stock ahead of common. That wrapper matters. A giant ETH headline is not the same as per share value for common holders. If the story is mostly ETH, why not just buy ETH, an ETH fund, or the preferred stock if it trades? BMNR Common may offer treasury growth, staking upside, and capital market optionality. But it also adds management risk, dilution risk, preferred claims, custody questions, and operating costs. So BMNR is not pure ETH. It is ETH exposure plus a corporate wrapper. The company calls its staking platform MAVAN, the Made in America Validator Network. Treat that as a company claim, not independent proof. Today, staking rewards come from Ethereum network activity, not from a normal software customer. Future institutional services may create customers, but investors need proof, actual revenue, uptime, custody detail, customer adoption, and costs. The February quarter is the anti-hype checkpoint. Total revenue was $11,041. Staking revenue was $10,201. Consulting revenue was $197. Leasing revenue was $424. Those numbers do not prove BMNR cannot grow. They prove the income statement had not caught up with the Treasury narrative. Digital asset companies can look strange because asset prices move through reported results. In the February quarter, BitMine reported a digital asset fair value loss of about $3.8 million. The 10Q also discusses ETH-denominated option contracts. Options can create premium income, but they add mark-to-market volatility and complexity. This is not just buy ETH and sit still. Now the headline, on June 1st, BitMine said it held 5,416,901 ETH. The company said that represented 4.49% of the total ETH supply. It also reported $11.6 billion of crypto, cash, and other investments it called moonshot holdings, including $446 million of cash. Here's a fast sanity check. If 5,416,901 ETH equals 4.49% of supply, that implies total ETH supply of about 120.6 million ETH. The company update also references about 120.7 million ETH. That does not prove the whole thesis, but it helps verify the scale. BitMine said 4,718,677 ETH was staked as of May 31st. It said that was more than 87% of its ETH holdings. That matters because unstaked ETH is mostly an asset price bet. Staked ETH is an attempt to create an income engine, but it adds validator, custody, liquidity, slashing, and protocol risk. The June 1st update projected $258 million of annualized staking revenue and $296 million of annualized staking rewards when ETH is fully staked. These are company projections, not guaranteed cash. That distinction matters because the next question is whether staking economics can cover the preferred toll.
The ETH pile is impressive, the staking projection is interesting, but if the asset base is this huge, why raise expensive preferred capital? This is where the video changes from an ETH story into a payment order story.
Preferred stock is not the same as common stock. Common shareholders own the upside after other claims get paid. Preferred shareholders usually get a priority claim, often with a dividend. BMNR's Series A preferred sits ahead of common stock for dividends and liquidation priority. That does not automatically make it bad. It means the preferred capital has to create more value than it takes. Here's the preferred toll test. Step 1, investors pay $80 per preferred share. Step 2, the dividend base is the $100 stated amount. Step 3, $9.50 of annual dividend divided by $80 equals an 11.875% cash yield at the issue price. Step 4, 3.5 million shares times $100 times 9.5% is about $33.25 million per year. 3.5 million shares at $80 equals $280 million of gross proceeds. Expected net proceeds were about $273.8 million, so the difference is roughly $6.2 million. The use of proceeds is broad, ETH, staking infrastructure, working capital, strategic investments, and possible repurchases. The key question is which use increases ETH per common share. Cumulative is the word to remember. If preferred dividends are not paid, they do not simply disappear. The prospectus describes unpaid regular dividends and additional compounded dividends. The final prospectus also lists redemption prices of 110%, then 105%, then 100% plus unpaid dividends. That is why this is not just headline financing. It is a risk stack. Now compare the numbers. The company projected annualized staking revenue of $258 million is about 7.8 times the estimated $33.25 million annual preferred dividend burden. That sounds strong on paper, but projected revenue is not the same as cash after costs, taxes, custody, volatility, and board decisions. The ratio is useful. It is not the finish line.
The June 1st update reported $446 million of cash. Compared with a $33.25 million preferred burden, that is about 13.4 years in a simple math exercise. But cash also funds ETH purchases, validators, working capital, investments, buybacks, and operations. If you want the follow-up when BMNP trades and the next filing updates share count, subscribe. That follow-up matters more than the headline.
BitMine applied to list the preferred stock under BMNP. If approved, BMNP trading may become a useful signal. Strong trading may suggest income investors accept the risk. Weak trading or a high demanded yield would say something else. But remember, BMNP is a signal, not a verdict on the entire common stock thesis. The metric many viewers want is NAV per share or market price compared with NAV. A responsible version needs live inputs, ETH price, cash, other assets, preferred claim, obligations, and diluted share count. Instead of pretending false precision, the right visual is a scenario table. Low, middle, and high ETH price, estimated preferred claim, diluted share count range, and rough NAV per share. Refresh this before publishing. Share count matters because total ETH can rise while ETH per share does not. The final preferred prospectus capitalization table used about 493.9 million common shares as of February 28th. The latest 10Q cover page showed about 537.6 million common shares as of April 13th. Investors also need to check options, warrants, ATM capacity, and future issuance. This is the main scoreboard. BMNR can report more total ETH and still disappoint if ETH per common share falls after dilution and preferred claims. Total asset growth is good only if common share capture improves. So the clean test is not just more ETH. It is whether common shareholders own a larger economic claim after the financing. For a crypto treasury, proof of holdings is part of the valuation. Investors should ask for wallet addresses, third-party attestation, custodians, private key controls, staking route, slashing protection, controls audit, staking revenue, staking costs, share count, preferred shares, and any repurchases. A giant treasury can still disappoint if investors cannot see who captures the value. Here's the compressed risk stack. 1, ETH price falls and the asset base shrinks. 2, staking yield compresses and coverage weakens. 3, custody, validator, hacking, or slashing issues damage trust. 4, regulation changes the economics of ETH, staking, or custody. 5, preferred obligations or future financing absorb too much value before common shareholders capture it. ETH price and staking yield are the biggest swing factors. If ETH rises and yield stays healthy, the preferred toll can look manageable. If ETH falls and yield compresses, the preferred claim becomes harder to ignore. If cash gets tight, dividends, ETH purchases, operations, and buybacks may compete. That is where the capital structure becomes real. The preferred also brings control risk. The prospectus describes voting rights in certain dividend non-payment situations. In simple English, if preferred holders are not paid, they may gain more power. That does not mean it will happen. It means common shareholders should not ignore the payment order. Bulls are wrong if total ETH rises, but ETH per common share falls. They are wrong if projected staking economics fail to become usable cash. They are wrong if preferred claims, dilution, custody gaps, or repeated financing absorb the value before common holders see it. The bull case is not proven by a giant ETH headline. It is proven by common shareholder capture. Bears are wrong if staking revenue comfortably covers preferred dividends, NAV per common share rises, custody proof improves, BMNP trades without stress, and reporting becomes clearer over time. In that version, preferred stock is not a trap. It is a funding tool that helps BMNR grow the treasury faster than the capital cost. The bull case must prove 4 things. First, ETH per common share grows. Second, staking turns into usable cash. Third, custody and reporting become clearer. Fourth, the capital cost stays covered. If those 4 things happen, the preferred stock could look like leverage on a growing treasury engine instead of a burden. The bear case wins if the treasury grows, but common capture shrinks. It wins if the last filed revenue base stays tiny. ETH volatility overwhelms the strategy, yield weakens, preferred claims compound, or future financing makes the structure harder to understand. In that version, BMNR is complicated exposure, not a clean Ethereum compounder. Here is the final GoGlides proof gate. The thesis gets stronger if ETH per common share rises, staking revenue turns into usable cash, preferred dividends are covered with room to spare, cash remains strong, custody proof improves, and BMNP trades without stress. The thesis weakens if preferred costs compound, ETH falls, yield compresses, dilution grows, or reporting stays unclear. The next catalysts are clear. Verify preferred settlement after June 10th. Watch BMNP trading if the preferred lists. Track the next treasury update for ETH held, staked ETH, and cash. Check share count and repurchases. Compare actual staking revenue with the annualized projections. And read the next filing for custody disclosure and common share economics. Subscribe because I am going to update this exact proof gate after BMNP starts trading, after the next treasury update, and after the next filing. That is when we will know if common holders are winning or if the structure is quietly getting heavier.
Bottom line, BMNR is not just an Ethereum bet. It is an Ethereum bet plus a capital structure test. The upside case is real if staking income and ETH per share growth outrun the preferred toll. The risk is real if preferred claims, volatility, dilution, and future financing absorb too much value before common holders see it. So which would you rather own? BMNR common, BMNP preferred, or ETH directly? This is not financial advice. Always do your own research.